Hello, I'm Brian Stevens from the National Real Estate Post. Today we have Dave Stevens, of no relation, with the Mortgage Bankers Association, the president, and he was the past commissioner for FHA. And what position will you be taking in the next administration?
I plan to be Donald Trump's limo driver. No, I'm just kidding.
Today, guys, we're going to be talking about the Mortgage Credit Availability Index. It's the only standardized quantitative index that really looks at mortgage availability. So for those who don't really understand what this is, can you give a brief overview of what goes into it?
Yeah, so the Mortgage Credit Availability Index literally looks at what products and programs and credit terms are available. And we use all regs in combination with data from Ellie Mae and combination with data that the Mortgage Bankers Association gets from its weekly application survey. And it basically is a trend line of what are we seeing in the overall single-family mortgage market, and how is that affecting sort of credit availability in the market?
Okay, so we're seeing these new Fannie Freddie 97% deals coming out, high LTV, riskier loans. So that would really kind of create the MCAI to increase. So right now you have naysayers out there saying, oh my goodness, well, credit availability is going through the roof right now. We're getting back into some of the riskier products that we saw in the past, and we're creating a storm that is all too familiar for us, and we need to pull in the reins. How do you feel about that?
Yeah, so this is where I think all of us in the business have to talk the truth. And so let's be real. The 97 isn't really a new product for Fannie and Freddie. We all know they had the 97 going back, more than a decade, well before the recession. And actually that program performs relatively well. It was pulled away very briefly over the last few years and then reintroduced. I actually don't think, and you guys who are originating know better than me, but I'm not certain how much of that 97 we're doing, because when you take the loan level price adjuster and the mortgage insurance, we're still seeing a lot of that 3% down product go to the FHA program. So that's not really changing the story here. The most important thing, and Brian, I know you'll show the graph that we put out in the data, over the last few years, yeah, credit has been expanding since the depth of the recession, as lenders are slowly but surely getting back into the purchase money market and being much more comfortable. New products are being introduced, particularly in the jumbo side. The high-end bank balance sheet product, as you all remember, during the recession, you had to put minimum 25% down. It became 20. Now they're at 15s and 10s out there in the jumbo market for good quality borrowers. That's where we're seeing credit expanding. But to be clear, when you look at the long-term view of where credit availability is back to pre-recession to now, credit is still extraordinarily tight relative to pre-recession levels. And that's the result of Dodd-Frank and the QM rule that require ability to repay. So that eliminates no-doc, stated income, and all that kind of thing. There's no neg-ams, no extended terms, no subprime 228, 327. Balloons are no longer allowed. I mean, the unsustainable products that drove the vast majority of defaults in the U.S. housing market are outlawed, banned, gone. So the expansion that we're seeing is all in the context of a QM world with ability to repay, fully amortizing product for the most part, other than some jumbo stuff on bank balance sheet. You can't compare the environment. So when they say, you're trying to do it all over again, I really get pretty incensed about it. I think we should be trying to do as much as we can to make the process easier for consumers, and doing as much as we can to make credit available sustainably for home ownership.
So, I mean, it would be fair to say, well, mortgage credit availability is up in the short term, but when you look at this graph here, there's a very pronounced drop off a cliff.
No, absolutely.
Go ahead.
Yeah, absolutely. By the way, when you look at that graph, the long-term graph, which you're showing, look not just during the bubble before the recession when it's way up there. Look even pre-recession levels to where it is today. We're pre-bubble period to where it is today. We have credit in the most tight range of availability, and you'd have to go way back in time to find any period when it's been this narrow.
So can you qualify how much this is actually hurting the mortgage market right now? Can you qualify how much it's hurting, any type of, bump in housing that we might see? Can you talk about that?
Well, Brian, the challenge is we never want to bring back what was done pre-bubble, right? I mean, I think we all recognize that the pay option arm at 100 LTV with a piggyback and fog the mirror and you get your documents at its extreme, we don't want to bring back. So the real question is like, what's the new normal and what's the right normal? And I think, the challenge for all of us is what's been taken away from us as mortgage professionals. I'm a guy who started as a loan rep, and I took my files to the bank teller to get the verification of deposit filled out once upon a time. This is going back pre-computer age. Mm-hmm. But, we used to be able to use something with a really good underwriter who knew how to read a tax return and read a credit report. We've lost this magical word. It's called judgment. That's been taken away. And so, unfortunately, the boundaries of rulemaking, in order to make sure we don't repeat the sins of the past, and from a group of regulators that still do not trust us, generally speaking, to use our own minds and make sustainable lending decisions, that's where you see on the margin probably 5 to 7% of prospective homebuyers who could qualify still not being able to get a loan today because we're so afraid of making a mistake, getting hit with a repurchase or an enforcement action. We just don't do that loan, or our companies won't allow us to do those loans. We need to be able to bring back, in a reasonable sense, judgment, so that when you're working in a community in, Southern Texas or New Orleans or Inland Empire, wherever it may be, Brown State, where someone lost their job, they're reemployed, they're a good borrower, you can explain their story. Those loans that can't get in today, that's where our focus collectively has to be. That's where I'm going to be focused for the next few years, particularly with this next administration while I'm driving Donald around. No, I'm just kidding. But,
I think I saw recently that, your average credit score for a Fannie and Freddie deal is, somewhere still in the mid-sevens. We've got meat and potato type of products out there right now. What would you like to see happen? Would you like to see new products coming to market? Would you like to see a loosening of standards in terms of credit scores, higher LTV? What would you like to see to affect the mortgage credit availability in the right direction?
Yes, I think this is a variety of things. So let me just start with the pricing construct. 2/3 of all loans, purchase loans to African Americans and Hispanics, is still going through a Ginnie Mae product. And you guys know this. You know what Best X looks like when you're looking at loan pricing. If your credit score is somewhere below 700, the execution on a high LTV transaction for Fannie Mae and Freddie Mac doesn't work. If they're going to be more aggressive in the space, they're going to have to figure out that when there's mortgage insurance with a high LTV product, whether that return is too aggressive for their balance sheet versus trying to figure out how to get some borrowers in. I mean, pricing is pricing. So that's just one variable. But let's talk about the fundamentals. A lot of Hispanic families that come here from Central and South America originally, who are green card, U.S. citizen, or on the path to citizenship, they come from often families and communities that didn't trust banks. We call them unbanked. And may not have credit established in the normal way. And I'll just give you my case, and I'm not from there. My son, who's in the mortgage business in Colorado, is trying to buy a car. He just didn't get a credit card in college. I actually thought getting credit was risky for a college student. He didn't have a credit card. He went to get a car loan. The interest rate was absurd. Now I'm going to try to help him get a car so he can afford it. But I mean, that's a kid with opportunity, and he's boxed out of getting access to credit because he didn't use debt. Our perspective around credit scoring modeling in general has to change, whether it's thin file. You may remember, Brian, as I did, used to be no credit is good credit. Well, today no credit is bad credit. And that's a problem because you can prove the quality of a borrower through some manual efforts elsewhere, paying rent on time, paying cell phone payments, savings histories, looking at their bank accounts, knowing that they have a good job, and just the fact that they don't have credit, meaning their score is too low, shouldn't bar them. If we don't figure that out, the entry-level homeowner, whether it's Hispanic family, Asian family, African-American, or someone who looks like me, like my son, it's going to limit the availability and access to credit. And we didn't have that limited construct going back pre-recession. We've lost the balance here. And that's just one example. Self-employed borrowers, non-married persons living together who are both self-employed, contributing to the house payment. A first-time home buyer may have a roommate who's contributing to the payment, a borrower with multiple jobs who has a day job and a consulting job at night or does something else. We all know how difficult that is to paper a loan file and get it past our quality control system and get that ultimately funded by an investor. We've got to find a way to meet the demands of the millennial generation, which is not going to be square peg, square hole. My first job, salary, I had a pension, 40 hours a week, same company, W-2. I mean, I got my two daughters who are graduates, both have the graduate degrees. One's working for a federal agency in Washington on a contract, and they renew the contract every year. They don't hire salaried employees anymore. You know how difficult it is to get qualified when you're on a one-year contract, even if it gets renewed 10 years in a row. I mean, it's a new world, and the mentality of 1950s underwriting standards applied through the qualified mortgage rule, I think, quite frankly, are limiting options for many home buyers.
So, I mean, I understand this, but you have these credit reporting agencies. So I think what I hear you saying is, well, they need to change their modeling to be more inclusive of some borrowers who have alternative type of credit. And when you're speaking of people who are on contracts, you don't have a 2-3 year guaranteed work in front of you. That's going to limit your opportunities. Now, you're asking privately held banks and privately run credit reporting agencies to make these changes, or can these changes be made higher up the ladder in Washington? I mean, where does the change come from?
I actually believe in this case, we need to deal with the regulators that are setting the standards, particularly in the conventional markets. So that would be FHFA in working with the GSEs to demand some piloting efforts to look at different ways of looking at credit. And put this in perspective, Brian, automated underwriting systems weren't even introduced until not more than a little over a decade ago, when they were fully embedded in the underwriting world of lending. They were introduced just before 2000, but during the early 2000s, it took a long time to even get those as the standard. We still read credit reports. Today, we don't. And we're using scoring methodology as a sole solution. I think the regulators have to demand looking at generational changes in the way people earn money, the way people use credit, and find different ways to do it. We all know, going back a long time ago, we would look for alternative credit to verify a borrower's ability and willingness to repay their debt. Today, we don't typically allow any form of alternative credit. We go purely by the score. So, this comes from FHFA, it comes from HUD and the FHA program. And I think this Consumer Financial Protection Bureau, in the way the qualified mortgage rule is written, I think the rule itself, the 43 DTI and Appendix Q, I think that's written far too narrowly. If we actually depended on that versus the patch, which allows Fannie and Freddie to drive the underwriting decision, we'd be narrowing credit even further. So we've got to work to refine the QM rule. We've got to work with FHFA and HUD to redefine and at minimum start implementing pilots to test how we help this new generation gain sustainable access to home ownership. I mean, seriously, that's where the work starts, because I think dealing it with lender by lender, through state agencies, et cetera, that's going to take a lot longer than if we deal with the macro providers of liquidity, which are Fannie, Freddie, and the Ginnie Mae programs.
So the average loan officer realtor watching this says, well, that's great, that's wonderful, but they feel handcuffed to make any changes here. What's the MBA doing right now? Are you talking with people on the Hill to make these changes? What efforts are you guys doing to loosen up credit availability?
Yeah, so that's a great question, Brian. And if our MBA secondary conference coincidentally is next week, I'm going to be giving a keynote from there where I'm going to be calling for some changes, and we'll do a lot of promotion of that message as we move forward. I know speeches don't mean a lot, but we've in the last few years called for things like single security before it ever started at the GSCs. We called for more risk share models before risk sharing was ever being done by the GSCs. We asked for FHFA to go through notice and comment on policies, not just roll them out to market. They're doing that today. All of these things are efforts that have been driven by sort of the louder, more organized voices in Washington. And so that's going to be the initiative. So one of our core beliefs, fundamental beliefs, is it starts with how do you define the process of qualifying a borrower to meet the ability to repay standard. I actually think a lot of it begins there. I think the push for credit score models, which we've been pushing aggressively with FHFA in particular, to work to take on FICO 9 and look at other scoring models like Vantage Score that can score more borrowers and implement those. These are efforts that are going to take some aggressive action with the MBA working in partnership with other groups, particularly consumer groups, to try to push these issues to become policy, not just something we're talking about. So we're very aggressive in all of this space. We have a consumer advisory council that we meet with regularly. It's the heads of all the consumer groups in Washington. They have a huge influence on the regulatory community. This is really going to be a partnership that we're going to have to form between industry and consumer advocacy to recognize that if we don't do something here, if we don't change this paradigm of the way we're underwriting and documenting mortgages, everybody who looks like me most likely is going to be okay, especially in my age bracket. But younger borrowers, much more diverse borrowers who come from families with different experiences, I think that's where we're going to have the struggle. And I'm not saying this is like a social welfare provider. This is business. This is a core fundamental contribution to the gross domestic product of our country and to the tax rolls of our communities. We got to fix this, and that's really where the focus is going to be.
And just one last question here. So, I mean, is anybody listening? Is this something that is a hot button item that the FHFA might be talking about? And do you think the outcome of the current presidential election might have any effect on this?
So first of all, the regulators are thinking about it. I think FHFA is thinking about it the most. I mean, they've been working to provide confidence with the GSEs to the lending community to be most comfortable to do lending. I mean, the 97 is an example of that, giving rep and warrant clarity to the lending industry so they don't put credit overlays in place. And they are talking about new sort of RFP approaches to think about testing new credit models. I mean, they're stepping in that direction. I think it's slow and it's methodical, but they are talking about it. Does the outcome of the next presidential election count? Yeah, I mean, absolutely. And I don't want to get into a partisan discussion here, but I think we know where Senator and former Secretary Clinton stands because she's put out a housing platform. And if you read it, it talks a lot about first-time home ownership, getting allowances based on savings plans that would be partnered with federal funds to save up for down payment and more. So she does have housing as a focus on her platform. We are working with Donald Trump's team, a couple of his advisors who we've met with here to talk about housing issues going forward. I've published some pieces, one piece very recently in my work with the Terwilliger Foundation, which is a bipartisan group, on this exact same subject about affordable housing, both in rental and home ownership. So, and it's not just me, there's a wide berth of sort of participants who are viewed as thought leaders in housing policy. I will tell you, Brian, I think fair lending, access to fair lending, access to credit, I think these are going to be the hot issues over the next 5 years. All the rulemaking is in place. We've implemented all the rules required under Dodd-Frank. HMDA is the last leg of that stool. There's no other rules required under Dodd-Frank to be implemented by the Bureau. We're going to be fully operationalized and have gotten used to all of this a year down the road. We're all going to be pivoting, I think, very seriously to things like student loan debt, building affordable inventory in the purchase market for young borrowers, and thinking about how we paper a loan file safely, but with greater flexibility to take into account the varied stories of the new home ownership market. And I'm hoping other people join in on this effort. This is, by the way, this is not about being reckless. This is about being prudent and careful, but making sure we don't deny opportunity for home ownership. I've grown up in this business, as you have. Sure. All of us are big believers in this. And, it's important, the work that everybody serves that watch your shows here. They serve the communities of our country. We just got to make sure the tools are there to do it appropriately.
Yeah, and I gotta tell everyone watching, I think Dave is spot on this. I just absolutely spot on with your analysis of the situation. And finally, one last question since I have you, and because we've been seeing a whole bunch of talk about this, and I didn't really care for the headlines, how I was reading them, which is the CFPB is going to rewrite Know Before You OTRID, and I was looking at the letter from Director Cordroy, and that's not what I was reading. It didn't match the headlines that were being plastered all around social media. Just real quickly, do you have any thoughts on that letter and what's going on?
Yes. So, if anybody's read the letter, he actually called out the Mortgage Bankers Association. It was an industry letter, but he called out specifically us for thanking us for the work we provided. They're not going to rewrite the rule, guys. So it's not going to be like a new form and starting over from scratch. That's not where we're going here. We've been asking ever since the rule came out, as have you, for clarity around what we all come to know as the black hole. How do I timestamp a file based on time zones and meet the requirement? How do I disclose a single close construction perm, because everybody's doing them differently? If there's a piggyback second for the purchase transaction, how do I disclose those, because it's not quite clear in the rules? And I can go on and on and on about just the various items that we're all trying to make sure we're doing right. I think people are guessing on how to do it right, but it's being done variably across the country. So that's the sort of black hole of work to be done. We've provided a specific list to the Bureau on those things we need to be answered. And then the second component is, can I cure minor errors? The director sent a letter to me personally at MBA, which became well known before the holiday. And in that letter, he clearly said you can cure errors. But as we all know, letters are not the same as formal agency guidance, and we now know that through case law that's happening today publicly in the court system. So we just want the Bureau to codify as much of what was in that letter to us. The director and the Bureau have to determine. They can't just sort of go out and say it. There's an Administrative Procedures Act, and this is too much for all of you, but there's process you have to go through to give clarity in a rule like this, and that's why he's going back for rulemaking to get the input on, like, what else do you need to know to make yourself comfortable in the rules so that you're not worried about gotcha enforcement or legal cases after the fact? And I really believe the intention is sincere. It won't solve all our problems, but it will answer a lot of our questions. At the risk of gaining a lot of attack here, I actually applaud the Bureau for putting this out. It's a little late and a little slow to make this all happen, but it is absolutely a step in the right direction. Do not think they're going to reinvent the rule. That's just not going to happen.
Yeah, pleasantly surprised you did say that, right?
Yeah, right. Good. Absolutely. We were pleasantly surprised and actually didn't expect it. I thought they were going to hold firm and not give us the clarity we were asking for. I really applaud the director and the team that pushed on behalf of industry. And guys, there are people in the Bureau who work solely to listen to us. In fact, one of them used to work for me at a previous company, and she and the rest of the folks over there do a really great job echoing our views. The reason why we don't win all the time is, remember, there's a lot of other people in the ears of the Consumer Financial Protection Bureau, civil rights attorneys, and others that do not trust necessarily our intentions or our motives as an industry broadly. Our job is to show that we're sincere, that we're deliberate, that we talk facts and data. We don't just scream at the wind. And we work closely with those that also have an ear to listen to us. And I think this outcome was positive. We'll see what happens. It's going to be over summer that this all goes on, but it's moving in the right direction.
David Stevens, thank you very much.
Thanks, Brian.